Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about GIC rates and GICs in general, and do they make sense with current low interest rates, and what is a better option? Okay, so let's jump into different options around GICs. And this is triggered by an email that I received from someone saying, we have a GIC at a financial institution. It's coming due. What should we do going forward? Okay, and they've given the client a couple options, and we're going to dive into that in this video. Before we jump into the content, if you haven't already checked out our financial masterclass, we launched a financial masterclass in 2020. We've updated it for 2021, and it has over 100 videos, contents, downloads. So if you enjoy the videos that we do here on YouTube, you'll love our masterclass. It really dives deeper into a ton of content. Again, you can check it out. We put the link below. You can look at the different modules that we've gone through. But again, there's over 100 videos, content, download that really will help you with your financial retirement, estate, and tax planning, and really answer a lot of the questions that you have, help create and bump up your financial literacy, and just give you the tools that you need to make better decisions around your financial plan. So if you're looking for that, check out our masterclass. Again, we'll put the link below. So yesterday I got an email from someone saying, we have $185,000 coming due in a GIC, and we're not sure if we should roll it into a new GIC or what the options are, basically. So their financial advisor that they use gave them some options. They forwarded that to me. So they have a 1-year GIC at 1.18%, or an 18-month GIC at 1.3%. So those are their locked-in GIC options. The advisor also gave them the option of an IA Clarington bond fund, okay? And the advisor talks about, well, the bond fund is going to pay you 3.85 yield. There's a fee of 1.5%. So there's a bit of a return there. But the problem with the bond fund, and again, no one knows what the future holds, but as interest rates go up, in general, bond funds, managed bond funds will go down. Now, you can buy an individual bond. They work a bit different. They're a bit of a better tool to use. But in general, bond fund, interest rates go up. Bond funds will actually decrease in value. So the risk there is that, are we going to see an increase in interest rates? We probably will see a bit over the next, 12 to 18 months. So if interest rates do rise, that bond fund has the potential to decrease in value, and essentially the client could lose money over the 12 to 18 month period that they're looking to hold this investment. So they need this money in about 12 to 18 months to pay off some real estate, some rental real estate that they want to get rid of. So at the end of the day, we have about a 12 to 18 month period. So what is the best investment for short term? 12 to 18 months, okay? They need the money, again, in 12 months. So they could go into that GIC. Again, it's 1.18. If we go to ratehub.ca, we can maybe find a bit of a better rate. But in general, GICs right now, as of the middle of June 2021, are paying anywhere between 1 and, as high as maybe 1.4%, okay? So that's kind of the rate, 12 to 18 month rate. But again, with a GIC, you're going to be locked in. There's little flexibility or zero flexibility to GICs. The odd one you can cash out early, you might lose the interest. So again, little flexibility and a very low interest rate at the end of the day. Again, the second option would be a bond fund, which this advisor told this person. Again, the problem with the bond fund is you do have fluctuation, right? Pull up a graph of any bond fund and you'll see, even last March, stuff dipped, bonds dipped in March. So be aware that bond funds aren't kind of a steady climb. They can have the ups and downs a little bit. So be aware of that, okay? The third option, and I think the best option, is to go into a high interest savings account, okay? So if you go to EQ Bank, and we'll put the link below as well. If you go to EQ Bank, you can set up a TFSA, a savings account, or an RSP and deposit money in there and get 1.25%, and you're not locked in, okay? So the benefit with that is that you're getting even a higher rate or almost as good a rate as a GIC. You have full flexibility. And as rates go up, which they probably will, EQ Bank historically has raised rates as interest rates have gone up, okay? So you have the potential to earn more money down the road. Now, the 1.25 could also drop. It fluctuates. But I don't know if we're going to see rates go down any further. I think we're going to be on an upward trend. It can, low and slow, but I think we're going to be on an upward trend. So I think in reality, I think 1.25 is pretty safe. Again, it could drop, it could go up, but you have that potential for it to go up. But in general, let's say rates stay the same across the board. If you're only getting 1.1, 1.2, 1.3 on a GIC where you're locked in and have zero flexibility, I think a better option is to go to EQ Bank, get your 1.25%. and have the flexibility that you need. Then maybe if you end up wanting, for this client, if they want to pay off their rental properties a bit earlier, they can do that. They have the flexibility. They're not locked into anything. If they have an emergency come up, they have access to that cash. So again, there's a lot more flexibility with the EQ Bank. Again, you have to look at your rate, your risk, what you're getting all together. Again, at GIC, you're locking in. The EQ Bank savings is basically 1.25, and you're not locked in. So huge advantage there. Now, I know, inflation, say at 2%, you're getting 1.25, you're losing out to inflation. This is a great strategy for, saving for an emergency fund or something like this. It could be a large amount of money, but for short term. Where do you put money? Short-term savings. There's really not a lot of great options in our low interest rate environment. So I highly recommend something like EQ Bank. I've done a lot of shopping around to see, who has the best savings. Manulife Bank often will see a rate to spike, and it's just a promo rate for like 30, 60, 90 days, and then it drops back way down to like 0.3, 0.4. Tangerine Bank is often doing the same thing. A lot of the financial institutions will do that, right? They'll throw a larger rate out there, but it's a short-term promo rate, but the long-term rate is much, much lower. So the EQ Bank account is just a great solution for a shorter term savings. So again, we use our EQ Bank personally for our property taxes. So we know that that's an annual bill we're going to have to pay, every end of June, early July. So what we do is we just save, monthly for that. We throw it into EQ Bank. We're getting our 1.25 savings. Is it the best? No. But at the end of the day, I know it's secure, and it's at the end of the day, for a secure, consistent rate, it's the best I've found out there. So again, inflation's at 2, we're getting 1.25. I know that's not a good spread, but again, I need that money every single year. I don't want to lose anything on it. I just want, I want the money to be there, and I want it to earn the best it can along the way. And again, EQ Bank's a great solution for us. So we use it for our property taxes. Again, it's another great place to hold your emergency fund. If you're any short-term savings, it's a great solution. Again, a lot of you watching this video will say, yeah, but Adam, this makes no sense, because if inflation's 2 and I'm getting 1.25, my money is working against me every single year, which I totally get. But we all have, periods in our life where we have a short-term savings need. And I've seen it too many times where someone will go against my advice, throw their short-term savings into the market dips, they need the money, and they have to pull it out at a loss. So whether they're doing it through a savings account or a TFSA or whatever it is. So, you can fall into that trap, you can go down that route, it might work for you, but there's risk there, right? So if you need money in 12 months and you throw money into the market, if you throw it into the market, let's say in March 2019, and you needed the money in March 2020, and you had to pull it out, okay? You could have pulled out at a 20, maybe even 30% loss, depending what you're invested in. So just be aware of that, right? There's risk investing money in the market at any time. There's even risk investing, like this advisor said, in a bond fund. Bond funds can go down. You're taking risks there. In general terms, bonds are the stability factor to your portfolio. But again, that's for longer term savings. For shorter term savings, they have fluctuations still. So again, short term money, look to something like EQ Bank. I think it's a better option right now than GICs. GICs just pay such a low rate of return. So maybe jump into the GIC in a few years when it's a better return. If that's your investment philosophy, it might be a better option for you. Again, you're gonna earn a little bit less now, but I think you're gonna earn a lot more later on. But anyway, looking at today, June 2021, I think the best option is a high interest savings over a GIC or bond fund or any other type of investment when it comes to short-term or emergency savings. I hope this video really helped you out, gave you clarity around GICs. I know a lot of you have emailed me or left comments on other videos about GICs, doing a video on GICs, how they work, why you should do them. The reality is right now in our low interest rate world, GICs don't make a ton of sense, okay? They pay a very, very low interest rate, much lower than inflation in reality. It's not a great investment. So, back in the 80s, you could get a GIC at like 15 to 18%. Which is amazing. Today, again, you're 1.5. If you do a 5-year, you can bounce over 2 maybe. But they're really, really low rates. It's not a time to get into GICs. Again, you're better going to EQ Bank. getting to 1.25, but having flexibility. So if all of a sudden rates start to climb, then maybe you lock into a GIC later on when the rates make more sense and jump above inflation. So just think about that. So hopefully this helped you out, hopefully guided you in your GICs. If you have GICs coming due, maybe you just want to transfer them over to an EQ bank or look at something like that as a better option short term. Again, if you're long-term investing, I think there's better options out there, but for short-term savings, I think EQ Bank's a great strategy. So thanks for joining us today. If you enjoy these videos, make sure to hit the thumbs up button. It really does help get our videos out to more people. We really appreciate it. And of course, if you haven't subscribed to the channel, which is about 85% of you, hit the subscribe button below. It takes 1 second. It costs you nothing, and we really do appreciate it. So thank you. We'll see you in the next video.